Welcome to Go Bank Yourself, where we break down how to grow and control capital like a banker. I'm your host, Dovi Herman, joined by my co-host, Pinny Levy. Let's begin. Hello, Pinny. Good afternoon. Welcome, world. Thank you for joining us once again, all 5 of you, maybe 15 of you.
Five.
The numbers are
This is
jumping
60
up.
plus. Exponential growth. This is
60
amazing.
plus subscribers. I hope they're all watching. I hope some of them are consistently tuning in to at least a minute or two of each episode. So until you get
Just need a
bored
minion.
and jump to something else, hello.
We just need a minion at least tuning in.
We just need a minion. For those who are not our Orthodox Jewish friends, minion means 10 men so that we can do the prayers to their fullest.
Right.
What do we got today, Penny?
Well,
We are talking about whole life insurance for the average person, for the average investor. We've had episodes recently talking about real estate and business ownership and some in-depth strategies, self-financing to buy a car. But what about the everyday guy who has a steady job, is saving money in his 401k, he has a Roth IRA, he really likes that, big fan of the market? We can play into that because we both know that there's no either or here. There are strategies that you can invest
right.
in the market and save money and good whole life policies and combine the strategy to be much more effective, especially in the long term, because this
Do you
is
mean you can
retirement planning.
dance? Do you mean that you can dance at 2 weddings?
I love how we're talking off camera and you come up with a phrase and you're like, I'm definitely gonna say that on
Yeah,
camera.
yeah. What does it
Yes,
mean to dance at 2 weddings?
exactly. Let's
Conventional
dance
side
at
of
the wedding.
investment, you can have your 401k cake and eat it after taxes, and you can have your infinite banking cake and enjoy it tax free. But tell you what, they go pretty well together. Both have some pretty good sugar, depending on something you mentioned earlier, again off camera, called sequence of returns. I've met people that are market adverse and they don't want to be in the market anymore, and they have their 401k IRA. They would love to liquidate, but they made a deal with the government a decade ago that they can't liquidate without penalty till they're 59 and a half. Or they live in a very high tax state, California. And,
California and New York.
and liquidating would be absurd because the tax bite would make it completely inefficient and not worth the liquidation because of how much of a tax bill they stand to pay. So what do you do then? Well, clearly you can just add what we love, infinite banking, whole life insurance. You can add that to the mix to get very fine results. Meaning when you're building, fine, you're just adding a new tool to your toolbox. You're adding infinite banking to that. But when you're distributing, when you've reached the top of the mountain and now you're living off of, you're retired, right? There's a classic expression, well, retirement means a lot of different things to a lot of different people. Are you a guy who's going to retire at the Ritz-Carlton and you're going to have a new chocolate on your pillow for your bed that's made for you every morning? Or are you retiring, in the Badlands in your trailer, your mobile home going through the national forests, and you're roughing it a little bit more than, what's your retirement look like? But when you're in retirement and you've got a burn rate, you know how much money you need, where are you going to get it from? Can you say with certainty what percentage of your conventional funds, your investments, your mutual funds, your IRAs, your 401ks, is there a fixed percentage that you know you can borrow every year and the funds will last as long as your longevity? Or is there a certain risk in doing that, in pinning any fixed number, and what you really need is some type of a buffer zone? Well, we have a buffer zone, don't we?
We do. I also want to separate the product of dividend paying whole life insurance and the concept, the strategy, the marketing term, infinite banking, because they're two different things. So right now we're really focusing on the product, dividend paying whole life, and how it can work is both an accumulation tool and a distribution tool, how it interplays with market-based investments. And let's separate that from the cash flow management strategy of infinite banking. So let's focus on whole life.
In this case, whole life is going to be earning, or whole life has its own associated equity every single year that's guaranteed to grow. Of course, in the insurance world, that's called cash value. But the theory I alluded to earlier is if you've got two piles of money, your market-based assets, and call these your actuarial assets. That's a very fancy term to say the money you have in insurance products. As they both grow, well, when you're in the distribution phase, if the market takes a hit and you no longer want to withdraw from your assets, you don't want to distribute from the market, you want to give it time to catch up, here's your buffer zone. The cash value of your dividend paying whole life insurance is now that buffer zone, because as we've talked about, and I'm sure we'll say it again in the future, that money can be borrowed against and never repaid. The death benefit ultimately repays that loan. That money can be borrowed tax-free and act like a Roth on steroids for you. Now what happens when the market picks up? I'm thinking 2008 to 2012. My very own parents, may they live and be well, they couldn't retire because their retirement was cut in half. What did they do? They worked into their 70s before moving down here to Florida and driving us crazy. May they live and be well. God bless them. No, we loved it. Most of the grandkids are down here. Is that right? Yeah, thank God. So you can work into your 70s waiting for the market to recover, or you can retire when you wanted to because you've got a buffer zone. You know, take the average Joe and Jane. What would you rather do? Joe, Jane, they'd rather have the freedom to enjoy a buffer zone and not have to work longer than they want to. In fact,
so a buffer zone, because you have your investment portfolio that hopefully grew a lot over the course of your working life, and you planned on living off of that, selling it off piece by piece as retirement income. Well, you planned on starting to, but it just took a 30, 50% hit, whatever it is, even a 10% hit. You don't want to start selling in that year. You want to give it time to rise back up. So while you're waiting for it to rise back up, you can go back to work and work longer than you expected to, or you can go exactly as you planned on, but now you have this buffer asset, a volatility buffer, a good whole life insurance policy that also accumulated pretty nicely over that long period of time, and now it has no risk of loss, and it's continuing to grow, and you can just borrow whatever money you wanted to take off that year and not touch your investment portfolio and give that time to rise back up.
Exactly. And that, I mean, the last time I looked at the numbers, it was the safe number, meaning I've got $1 million in retirement right now. After taxes, after fees, after market risk, what's the safe amount of money I can take out per year? If you thought 5%,
right?
Right. Well, how much can you enjoy per year as a percentage of what you've got? I mean, even
because of taxes.
Because of market risk, meaning what's the safe percentage withdrawal that you can withstand per year? It's something like high 2s, low 3s. And you're really not accounting for the situation, the national situation, if you say any higher, because where could taxes possibly go when the debt tops 40 trillion? Where could regardless of the administration, capital gains have to go up, income tax has to go up. So all of today's plans that aren't counting on a higher tax bracket even in retirement, they're not being conservative enough. But when you say, well, regardless of the tax bracket, regardless of the market performance, I've got a buffer zone. I can make up the losses this year with my whole life cash value. I can borrow it. I don't have to pay it back. And even as I borrow it, my funds are still accumulating. My dividends are still being earned year after year as if I haven't touched them in the form of a loan. So there's, without going deeper on the whole life, the gears and exactly how they work, just having that buffer zone is a great peace of mind for, I can't think of someone who would poo-poo it. I don't want it. I'd rather live at the risk of the market, or I trust that I can get 5% a year no matter what, and that my growth will outpace my distributions and my taxes and fees. Yeah, understand that point. Your $1 million is not going to produce an eternal $50,000 a year in income. Certainly not. But and then what? And then certainly, if the market corrects, right, then goodbye to your $50,000 that year. Because if you take it out, you've just killed your ability to recover.
And I'm not the market expert over here. Definitely not. But when people think about receiving income based on their portfolio, you're usually thinking in the form of dividends, right? That's what produces income. Well, how many stocks these days compared to 40 years ago even pay good dividends? Most of the market has turned into growth stocks. So you really have to be strategic about what you're going to sell and when.
Yeah.
You can correct me if you think I'm wrong.
No, I think you're right. But what we come across a lot is someone who wasn't really working on their own in 2008, right? We only have to go back 18 years to know when things were really bad, and investors were killed, and donors in our communities were killed, and new money was not flowing from banks into new projects. And people who were living off of investments at that point were in trouble. Fixed income was now turned upside down. And we would be silly not to plan on or envision that it could happen again. It has to happen again.
Sure, markets work in cycles. There's always a business cycle. It's been a long bull run, and we're not trying to be the doom and gloom guys. But there will always be some sorts of correction. It's just how the business cycle works. We might see that tomorrow. We might see that in 5 years. But if that happens, especially in the early years of someone's retirement, what is it? The last 5 years, there's a 10-year period that will affect your retirement planning more than any other years. And that's the 5 years before you plan on retiring and your first 5 years of retirement. If there are large corrections in that 10-year period, you have to rethink your entire strategy.
Wow. Yep, and that's all the conventional wisdom. We're not saying anything new, or that any big fund manager isn't going to tell somebody, or a portfolio manager, that that's what you have to deal with. For the majority, now we'll keep it for the majority. We're not going to rely on the elite who have their own ways and say that they have a way around this.
I mean, we could talk to both.
That was dancing in. It's a phrase, by the way, of being on both sides of the fence. You could be invested in the market, and you can have assets within whole life insurance. So
right.
Again,
we mentioned sequence of returns risk, the order of the ups and downs in the market as it relates to your investment strategy. When those downturns come, when those years of losses come in retirement, can affect each person differently. So how can you protect against that, what is called sequence of returns risk? to have that volatility buffer. Well, on the other side, where it goes hand in hand with any type of investments, is so you have your safe asset, your whole life insurance policy that's going to get solid, consistent, stable growth over the long term, and you have your riskier, higher growth, hopefully, investment strategy. Well, now that you have your safe asset, you can really be a lot more, I could say risky, I could say more growth oriented. I could say,
Aggressive.
give me a word. That's the word I'm thinking of. You can be much more aggressive in your investing. You don't need a classic 60-40, 60% stocks, 40% bonds portfolio anymore. You don't need target date funds inside of your Roth IRA. You can be as aggressive as you want to be, knowing that you have this safe, stable asset that's going to get decent, not amazing, decent long-term growth. And once it gets there, and year to year, it's never going backwards. It's only going forwards. And once you get past that 20, 30-year period where you've grown this asset significantly, you have zero risk of loss. It's a great volatility buffer. It's only going to grow from there. And as a retirement strategy, when it comes to drawing income from both buckets, it works a lot better in tandem.
Yeah. And not just to pile on, but there's also other things that are inherent in a good whole life insurance policy, like the life insurance industry's version of long-term care, meaning care for the nursing years, for senior years, for senior care. There are riders that can alleviate the cost of those eventualities in life. So there's a lot more that meets the eye than just the volatility buffer here. But
yes, a lot more. I don't want to, not to cut you off. I love that we're talking about life insurance. Let's also talk about the main reason of why we're maybe not the main, but I know a big reason of why we're buying life insurance policies for the death benefit. Well, now you're going to recover all that cost. There's very little actual cost of these whole life policies. It requires a lot of upfront capital to get started for this to work properly. You're going to have a large death benefit attached to it, rather than just buying term policies that 99% of the time are a pure cost, and they are important. Again, term policies are important. They have their place. Watch is buy term and invest the rest really the best. We do like term, especially from good mutual companies that are convertible. But now with a good whole life policy as an investment strategy, you're locking up that death benefit. You're buying that death benefit for the long term. You're not putting a bill every month on life insurance, unless, of course, it's not a large enough death benefit at the time and you need term to supplement. A lot of people do that. That's very important too.
And now think about tax strategy. Think about any time that you've neglected or waited to enjoy the benefits of an investment because of the current tax rate. So it might not be just that, hey, the market is down. There might be other factors that make someone say, I can't take my money out this year. I'm going to get killed. Right? The capital gains has been anywhere from 15 to 30%, a little higher, a little lower, but over decades, it's constantly jumping around depending on the mood of the executive political party in office. It's definitely a risk. I mean, you can count on Republican or Democrat, just to keep it binary, no more than 8 years in office before the political color flips, and then where are you? So can you plan that? 4 years from now, we'll probably have a Democrat president. Do you want to then say that means? Tell you what, I don't necessarily say that that's the only reason why taxes would go up, even capital gains tax. I'm a little bit more in the Debbie Downer that, listen, with approaching 40 trillion in national debt, that taxes have to go up no matter what. Wherever they can get it, the politicians will just wash their hands of it and say, there's nothing I can do, it's out of my hands. Taxes have to go up across the board. So when that happens, until there's some type of austerity or national recovery, if we're in a long-term environment of elevated taxes, well, even then you can turn to your tax-free buffer zone.
Right. We don't have a crystal ball. When those taxes grow, that might be far, far out in the future. We have no idea. Not everyone, but a lot of people probably in our camp were thinking that interest rates have to rise to battle all this inflation. Well, with this new Federal Reserve chairman, it looks like he's talking about dropping interest rates significantly, which could push inflation even further. So, yeah,
or kick the can until it has to. It has to
kick the can, but yeah. How long has Washington been kicking the can, and people keep saying, well, you can't kick the can down the road forever? Well, maybe they can for a lot longer than we think. Yeah. I'm not saying that I have such strong opinions on either side. I think we have opinions on what should happen to fix some problems, but who knows when they're going to happen. They could do this for generations. We have no idea.
There's an unfortunate saying, which is historically true, that how do nations fall or fail? Nations tend to fall little by little, and then all at once. So it could be kicking the can forever until, God forbid, sometime when another country says, well, I think our currency is stronger. Let's make the Chinese currency the global reserve currency for oil trade. Anyway, we living in the present and the now, because you can't function. Okay, it doesn't not make sense. I.e., it's good to have a backpack full of some shelf stable foods and ammunition in case you've got to get out of Dodge. That's fine.
Yeah.
But we're stuck living in the now, in the present, meaning our taxes could go up gradually, and even if they spike every 8 years, there's planning that we can do for that. There's an institution that's been tax free for 100 years before the IRS came on the scene. That's back to our mutual whole life insurance and the cash values, the equity that we grow inside there.
Yeah, I think it's great for us to be speculative and guess what's going to happen and what should happen, and give our opinions and maybe our little I hate to say conspiracy theories, because sometimes that's the way people take it. We know that that's not actually what we're doing.
Right.
But it's also important to stay grounded and to speak in fact and in truth. Are you familiar with Trent Fortner?
Nope.
He used to be an agent. Now he is a coach. He coaches agents on how to be the best life insurance agent they can be. He knew Nelson. He was big fan of becoming your own banker. He does not promote it, I don't think. But a lot of the people that we have heard of have worked with him. Garrett Gunderson, for instance. Well, he was just on a podcast, and he shows that in his meetings, he's just talking fact. How whole life policies work, how other investments work. And that's what I think we were trying to do on this episode, and show how it doesn't have to be one or the other. You don't have to say, oh, the market's rigged, the market's a scam, 401ks were created by the government to steal your money through taxes and whatever other things we might say sometimes and other people say. But we're trying to not say that. You can have a good retirement strategy using market-based investments if that's your cup of tea, and
it's enhanced.
how good whole life policies will improve that strategy, no question. And that is a fact. And to present that, how that works from a factual perspective.
If you really want to geek out on that, there's mathematical, university level white papers written on how balancing your market assets to your insurance assets, ultimately with a 1-to-1 ratio. Not I'm paying in the same, but at a target date, I want them to be equal, those values. Then that really does afford somebody the best retirement, or the most dollar and ability to enjoy more of each dollar, regardless of market and taxes, but in retirement. So comment below if you'd like to get a copy of that. Happy to send it out.
Yes. Everyone, you know what to do. Comment. I don't think we had any comments. Maybe 2. Engage, guys. Give us some comments, some likes, subscribe. Send this to a friend, even if it's just to rag on us. That's okay. We can take it. I know. Look at these fools. We're these peddlers, these scam artists. Believe me, we are not artists.
I've never heard that whole life is a scam. Never heard the phrase in my life.
You guys aren't gonna hurt our feelings. Thank God we are secure enough in our opinions. We may this game, this business is, at least to do it well, is all about transparency. To be as honest as possible, really, and to be the best communicator. We're trying to communicate, to teach. We don't always say things in the clearest possible way. The goal is to break this down so that a child can understand it. It's not always that easy, not because the child can't understand it. They can, but because these concepts, sometimes it's difficult to break them down and simplify them.
Yeah, it's not
See, that didn't make any sense. How did that sound? That sounded terrible.
Well, go back and edit it out. We could
No, I'm
say,
keeping that in.
We could say, maybe someone's curious, well, what does the process look like if they do knock on our door and say, walk me through this? I'm interested in whole life or in infinite banking. What would that look like for me? So future episode, maybe.
Future episode, definitely. We are going to keep on rolling with this thing.
Yep, God willing. So
yes.
I guess that's all for today, folks. We'll catch you on next week's episode, God willing. Until then,
Looking forward.
Josh, Pinny, Levy,
Dovi Herman, thank you for joining us. We'll nail the outro one day.
The quirkiness is we're going to go back and laugh at these when we're all polished someday, but
yes,
it's on the long-term thing to hire the Hollywood director, right? And now
this is our trial run. Pre 1,000 subscribers. Well, let's say pre 200 subscribers. This is just practice.
Polish it up later. All right, man.
Thank you for listening to Go Bank Yourself. To learn how to apply these strategies in your own life, email Dovi Herman at realchangefinancial.com. We'll see you in the next episode.